Welcome to another S&P 500 weekly analysis video. Today is October 1st, 2023. Last week, the S&P 500 got a nice bounce near some inflection points. And this weekend, the politicians were able to avert a government shutdown. So what do these things mean to the market in the coming week? In this video, we'll look at the inflection point, the market sentiments, market internals, price action of the S&P 500, the dollar, oil, and gold to see what they are telling us. So stay tuned. Looking at this chart here, you see the weekly performance. The Dow Jones Industrial was the worst performer for last week, and the Russell 2000 was the best performer. The Dow Jones Industrial lost 1.33%, while the Russell 2000 gained almost 0.5%. But for the month of September, the Russell 2000 was the worst performer. It lost 6%, while the Dow Jones Industrial was the best performer and lost only 3.5%. But all in all the indexes are negative for the month of September. On this monthly chart of the S&P 500, we notice that there were two consecutive down months, August and September. These two consecutive down months, negative month, usually followed by a positive month. But the last time that we saw two negative months was back in August of last year, and then we followed by a positive month on October. Similarly, at the beginning of 2022, we saw two negative months and then followed by a positive month. And looking back, some of the previous two consecutive down months, we see most of them followed by a positive month. You can see these, some of these examples here: two consecutive followed by an up month, two consecutive up month, and then two consecutive up months. So could we see a up month for this October? We'll see, because right now also the other thing is I have is this long-term trend line between using the low of 2009 and also the pandemic low. And that brings it, if we put in a 50% retracement level to see where this might lead to, and that would be down here somewhere around this 2750 area here. Now, the reason why I want to look at the 50% retracement is notice that from the pandemic low to the 2022 January high, this all-time high, see that after two consecutive down months, that started a pullback, and it pulled back to a 50% retracement level here, somewhere around 3,500, and also that's where we also connected the trend line, and we got a nice bounce back up. So now if we say the history will repeat itself, and we could see a beginning of a pullback from this two consecutive negative month, then we would likely see a pullback to the 50% level, and that could be also bring the price down to this trend line here, and that will bring down near the 4,050 level. Looking at this weekly chart of the S&P 500, and before we talk about the inflection points, let's just focus on this 4 consecutive down week here. See that we have 4 consecutive down week. The last time that happened is back here in December of last year. And we also saw 4 consecutive down week. And notice it's followed by at least one positive week. And here, back here also, we notice that there's been 4 consecutive down week and also followed by a few up week, 3 up week here. So at least we could say that after 4 consecutive down week, the likelihood is that we probably will see an up week. And if that is the repeatable pattern, then we could expect a positive week for this coming week. Now, the last time that we saw more than 4 consecutive down week is back here in March of 2022 or beginning of April. We saw seven consecutive down week. So it's not saying that we won't be able to see this down here, but here are the inflection point that we noticed last week. First and foremost, is from this high to this low. It is exactly 8% we got to bounce from that low. This 8% is very peculiar, right? Because most of the people talk about pullback anywhere between 5 to 8%. So is this a coincidence, or is this just some sort of a reaction to some price level here or some fundamental event? Now, in addition to that particular inflection point, we also noticed that it came down to this January pivot high here, somewhere around the 4,200 level. And we also got this trend line, almost came down to this trend line here. So that's another inflection point. And in addition to that, if we put in a Fibonacci retracement here, and a 50% retracement is also near this level as well. So those are the inflection points that kind of prompt this reaction of the price bouncing off from this level here, close to this level near this 4,200. With the avert of the government shutdown over the weekend and these inflection points, these technical bounce, we probably could see a bounce in the coming week. Now, that's not guaranteed. So we're going to take a look at the sentiment and internal and see what they are telling us. Now, looking at this sentiment chart here, notice that I have a little bit of a declining price channel here on the S&P 500. And you see the price declining from mid-September on and come down to this low here. And we also notice that the VIX throughout that time never got into this panic zone. It's still below the 20 level. And last Friday, it closed at 17.5. And in addition to that, the put-call ratio did come up to above 1, and it came back down into this zone here, 0.75 and 1. Now, before I continue, I just want to bring to your attention that you might see a little bit of a different chart here on the put-call ratio compared to the last few, maybe a few months or so, that it might look different. And the reason why it looks different is because inadvertently I have changed that at some point in time, was looking at the NASDAQ market, and I was looking at the put-call ratio in the NASDAQ market, and I forgot to change it back. So right now, we're basically looking at the entire market, all the options available. And so right now, we're looking at a pullback on the put-call ratio back into this head zone, because when we get above 1, we see that the market participant are a little bit more risk off and buying more puts than calls. So right now, it seems to be coming back into a little bit more of a hedge, cautionary type of zone here. So although the market participant are still not panicking, but they are a little bit fearful. And maybe that will change in the coming week. We do have the non-farm payroll coming out this Friday. And also, we have Jay Powell speaking early this week. So that could also throw in some volatility. And here, looking at the internal on the up-down volume ratio here, that there is a little bit of a negative on Friday, but that's not much to write home about. We're seeing 1.1 minus 1.1 up-down volume ratio, and also a modest 236 more declining issue than advancing issue. On Tuesday, we saw this broad market decline and broad market sell-off here with the advanced decline down at this minus 2,000 plus. So there were more than 2,000 declining issue than advancing issue. And also the up-down volume ratio was down at minus 7.2. So it's 7-1 in favor of the down volume. So we see that quite a lot of improvement came in after that Tuesday. So we see that little bit of a bounce. And when we saw this reversal here, when it got near that inflection point, those inflection point. In addition to that, we're also seeing a contraction of the number of stocks making new 52-week low on Friday. You see, originally in the beginning of the week, it was up over the 200 level. And on Friday, it came back down to 88. So there are a lot of stocks moving away from the low, or at least it did not see a further decline to make new 52-week low. So also the margin, the difference between the new high, new low is also coming back up to at minus 59. And originally it was down here, minus 200 or more. And we are not seeing any divergence on between the cumulative AD line versus the S&P 500. In the NASDAQ market, we also noticed a nice turnaround on the up-down volume ratio as well. After the Tuesday sell-off here at 2.7 to 1 in favor of the down volume, we noticed that the last 3 days of the week was all positive and finished with a 1.4 to 1 in favor of the up volume on Friday. And also the advanced decline was a little bit modest, 107 more advancing issue than declining issue on Friday. But that's after a very negative bond market sell-off on Tuesday with minus 1,544. In other words, 1,500 or more declining issue than advancing issue on Tuesday. Also notice that there was a nice turnaround on Wednesday after it booked below this pivot low here, the August low here, and we saw a nice turnaround there on Wednesday. And in the NASDAQ market, the 52-week high, 52-week low also saw a little bit of contraction on the number of stocks making new 52-week low. See that it was up here way above the 300, 400 level, and on Friday it contracted back down to only 165 stock make new 52-week low and 41 stock make new 52-week high. And the difference between the 52-week low and 52-week high also has shrunk from minus 400 or more to 124. So there were only 124 more 52-week low than 52-week high on Friday. Now, for the cumulative AD line in the NASDAQ market, although we did not see any new negative divergence, but we are still waiting for this negative divergence to get resolved. So with the market participant getting back in the hedge mode instead of the risk-off mode per the put-call ratio, and the fear is still there. It's basically they are still in a little bit of a cautionary mode here. But with the improvement in the internal, we could see that maybe due to the historical price action, we could see a bounce here for the coming week. With the averting of the government shutdown, and so it depends what Jay Powell has to say, and also what the job opening have to say on the non-farm payroll report. But those numbers, I always say, those are make-up numbers anyway. Be careful and pay attention to the revision. I think that is more important than look at the number that they report, because those are fake numbers. They are great. We've been seeing revision on those numbers for the last 6-7 months. I don't know how many months we've been seeing those revisions. Now let's take a look at the U.S. dollar and the gold and oil before we take a deeper look on the indexes price action. And look at the U.S. dollar here. We see a snapback here last Friday and stay above this pivot high here somewhere around 105.88. And looking at the U.S. dollar future, I am looking at the possibility for it to come up to this level here, somewhere around this 107.30, up at this edge of this balance area here. Right now you see that it came down to this lower edge here, and it got a nice bounce back up into this area here. So if it continue to move up, then I expect it to come back up to this volume edge here, this upper edge at 107.33. Now if we come down and dip below this zone, this low volume indentation here, we could see it come back down to somewhere around this 104, 105 area, near the composite point of control, and see if we get a bounce off of this high volume node here. And last week we saw the 10 and 2, the yield curve came up a bit here. It was previous week, it was down here at minus 0.7 area, and it came up at minus 0.47 this week. And that was due to the decline in the 2-year yield. It came back down to near the 5% level, while the 10-year yield went up to 4.68 before it pulled back. Still right now sitting at 4.5%. And last week, crude oil pulled above the $95 a barrel before it pulls back. So right now it's sitting at this $90, just above the $90 a barrel. I'm still expecting oil to come up to this 96 area here. So we'll be keeping an eye for higher oil prices to come. Now with the strong dollar last week, we did not see a good week for the precious metal. And looking at silver, you see that it broke down from this trend line and came down to test this 22.28 level. So I wouldn't be surprised to continue to see precious metal and silver continue to come down and possibly test this 21.55 level here. Gold didn't do any better either. It booked this 18.75 level. I'm looking for gold to possibly come down and test this 18.56 area, this edge here. Now let's take a look at the price action of the indexes using their ETF. First, start off with the diamond, the Dow Jones Industrial. As you can see, looking at last week, let me put back the last week's range here. And look at last week's price action. You see that it came down to the lower range and got a nice bounce. And last week it was pricing it not to fill the gap. You see how it came down to the gap and bounced back up and came back up to the composite point of control. Now for this coming week, we're going to see the price, actually the market pricing it down to fill the gap. But if it bounced back up, it only bounced back up to this pivot low here. So we'll be watching the Dow Jones Industrial most likely will come down and try to fill this gap before we could start looking for a bounce here and maybe bounce back up. Now, anything is possible, right? That's only one scenario. I mean, with the government shutdown, we could see a bounce back up here and test this pivot low before it pushes back down. So the key here is watch these level, so depending on which direction the market decide to move, you watch the level and then look for reaction up at those level. And that's the whole point and exercise for these scenario. We're not trying to predict which way it's going to go. We basically just try to, plan on where the price might hit and look for reaction if it go to a certain direction. Okay, so for the Dow Jones, we're basically looking for this pivot low here. If it come up and basically the upper range of the expected move, which is between 341 and 339 or 340. Then on the downside, it is expected pricing in to fill this gap and come down to this pivot area here. So we are looking at the lower range between 330 and 328.70 on the downside. And for the SPY, the ETF for the S&P 500, we noticed last week it was pricing in to come down and fill this gap. And you see the price actually came down to the lower range and filled this gap, and it got a nice bounce off of this trend line here. And it came up almost to this pivot low before it rejected back down to this 425.82 area. So for the coming week, we'll be looking at these ranges here, the upper range between 336 and 335. And notice that it is pricing in to get into this gap, not necessarily fill this gap. So, but if it come up to this upper range, there's a possibility that it could fill this gap. But then also on the downside, it is pricing in to break this trend line and come down into this pivot area here. So keep an eye on that 420 and 417.50 zone. So basically it's the 420 that we are keeping an eye on for the coming week. Now, if you want to see my daily trade plan for the SPY and also the E-mini S&P 500, go check out my Substack page because I publish a daily trade plan for these two instruments. And for the Nasdaq 100 ETF, the QQQ, we are also looking at last week's range here, that it came down close to the lower range because we're expecting that market was pricing in for it to come down to this level here. And that's basically the edge of this balance area. Notice it came down close to it, but we did expect to see the price come below this pivot low here, which it did, and then came back up with a bounce, and now it's back testing this trend line here. So for the coming week, the market is projecting it for it to come up and fill this gap and possibly move up to this composite point of control, or at least come up and reclaim this trend line. That's basically the upside scenario. And that upside, the upper range is between 368 and 366.30. Now, on the downside is to hold this level here, this edge here, basically these low here, hold above these low, and the lower range is between 350.30 and 348.50. So we'll see what it'll be able to come up to fill this gap because we are expecting a positive week for the coming week after that 4 consecutive down week. So we'll see how that play out. And for the Russell 2000 ETF, the IWM, we look at the last week's range here. It was pricing in for the price to come down, break this trend line, and possibly get into this gap here, fill this gap. But it did not come down. As a matter of fact, it bounces nicely until Friday. Kind of got a little bit of a rejection from the open. And also on the upside, it was pricing in for it to come up to fill this gap. So it did neither. It didn't fill the gap below, it didn't fill the gap above. And looking for the coming week, the market is pricing in to once again try again right? Basically come up and fill this gap or come down and fill this gap here. So looking for the possibility of a bounce this week, we could see it come up to the upper range, and that is between 181.30 and 180.60. Now, again, anything is possible, so we could see a reversal as well once it come up and fill this gap and then get rejected and pushed back down to this trend line. Then we'd be looking this lower range to be in play, and that would be in the area between 172.90 and 171.80. So for the coming week, the key level for the S&P 500 is the 4,200 level. If it could stay above this 4,200 level, then we could see it possibly come back up to this 4340, 4400 area. But if it dipped below the 4200, then we'd be watching closely for this 4100 area, and the possibility of working toward this 3800, the March low. So I hope you find this video to be useful, and be sure to smash the thumb up to give it a like and help promote this video on YouTube. And if you are new to this channel, click the subscribe to support the channel. Thank you for watching and stay safe.